Hello class. Wanted to spend some time reviewing the answers, or at least a what I would consider to be the most correct approach to this test review involving some information from Microsoft, a trial balance as of June 30th, 2018. And we're going to work through or look at all of the steps to review all that we've learned so far, except for cash flow. So the first thing that you received or found in the file is a trial balance with these numbers here. And if you're going to make this work, you need to identify each item as either a normal debit balance or a normal credit balance. And so gains are credit balances, revenues are credit balances, liabilities, equity, and expenses, losses, assets are debit balances. If you put everything in the correct side, your debits will equal your credits. And Excel, of course, does a wonderful job of telling us that. If we have a formula in our file there. And then we can make our adjustments, start making our adjusting entries based on the data we have. So allowance for doubtful accounts should be 2%. We see what 2% is of the accounts receivable, and it is not what is recorded in the allowance for bad debts. So we're going to change that allowance. Allowance is 301, we need it to be 397. And so we take and make a journal entry for credit allowance and debit bad debt expense for 96. So each of those is recorded there. We're going to amortize 6150 over 8 years, so 8 divided by 8. We never have salvage value on anything that's intangible. When we're done using it, it's useless, okay? So there is no salvage value on that. 800 million short-term debt has been refinanced, but we have an agreement in place at the year end. Even though it doesn't actually happen until after year end, as long as it's in place, we can treat this short-term debt that's technically short-term as long-term according to GAAP. So we're going to move that 800 from short-term to long-term debt, debit the short-term debt and credit long-term debt. Unearned revenue, we're going to figure out what 1/12 of all of the short-term unearned revenue from the trial balance is, and 1 month of that is going to be recorded. The amount is 1929. We're going to credit revenue, debit the unearned revenue. All right. Contract, long-term debt, we're going to have to calculate some interest from April 15th to June 30th. So April, May, half of April, May, and June, 2.5 months. Contract for maintenance on May 1st, the entire million was recorded as revenue. So, but clearly it hasn't all been earned. So we have a situation where we recorded 60 million that really is unearned. And so we need to say, all right, May and June have been earned. We can leave that alone, 2 months worth. But the other 22 months needs to be debited to revenue and credited to unearned revenue. Unrealized loss, we're going to adjust for that tax rate from 6 to 5, the tax rate 20%, and we're going to debit an unrealized loss, or if there's gains already there, we're going to offset with the loss, and we're going to credit an asset. Now, you'll notice I use something that doesn't sound exactly right. You can certainly add a valuation account or a separate account for this. But I chose to try to keep things relatively straightforward in terms of the number of accounts, and so I put it in something that was somewhat close but is not exact. since the amount is somewhat immaterial in terms of where it should go. Insurance payment, this is another situation where we recorded the expense and not the assets. We need to move some of it back to the asset because some of this has not been used. So we're going to debit the asset and credit the expense. As promised, there's an error from 2016 that we're going to have to adjust as of to retained earnings in 2018. Now, if we were disclosing 2016, we would actually have to fix 2016, 2017 from a disclosure point because both of them are currently wrong, but this is only dealing with 2018, so we do not have to do that disclosure. We just need to fix our retained earnings and accumulated depreciation for the current year for 62. Now, to handle a discontinued operations, we're going to separate out the assets, the revenue, the expenses of the part of the business that we're going to sell. Now, notice we're not going to sell it until August 1st. That's after June 30th for $5 billion. So we do not have to worry about the sales price or the gain on the actual sale of the business on this financial statement. We would do so next year, following year. But we do need to separate. We know it's going to happen, so we're going to separate all the assets out, and we're going to credit each of these assets, except for the accumulated depreciation and amortization, which we're going to debit because those are Contra accounts, and the total of that is going to be $4,033,000. That's going to go in on the trial balance or the balance sheet as assets held for sale. That's a current asset because it's going to be gotten rid of before next year. We'll do the same idea on the income statement. We're going to subtract out the revenues and expenses associated with the part of the business that's going to be sold. So the way I did that is we just made two more columns, treated it just like our adjusting and correcting columns, and debited and took out the discontinued revenue and the discontinued expenses, which then of course changed what we put on the income statement. So from a balance sheet standpoint, we got the $4 billion I should say, dollars of assets that are held for sale. On the income statement, we're going to create an income statement without the revenues and expenses from the discontinued operations. These are all coming directly from the trial balance. Then we're going to take the discontinued operations, the 11, we're going to subtract out the expenses, and we're going to get the net income essentially from that discontinued operations, which is going to be the 1081. We're going to take off taxes off of that at 20%, and that's going to leave us with discontinued operation of 665. 3 earnings per share calculations. I gave you the number of shares outstanding. We're going to take the income from continued operations, discontinued operations, and the net income and divide it by the number of shares outstanding. Taking the net income, it goes down to the statement of comprehensive income. We got our 3 items of other comprehensive income, and then total comprehensive income at the bottom. Statement of changes in equity. Microsoft combines common stock and additional paid in capital together because they have no par stock. We're just going to put the 200 that I mentioned. Retained earnings has its own column with dividends, net income, and your error correction. Your other comprehensive income comes down here to affect accumulated other comprehensive income. And then finally, the numbers from the statement of changes in equity or changes in stockholders' equity come down to the equity section of the balance sheet. So 68,366 the 18628, the 3703. Set this up with formulas in Excel, and it gets all taken care of for you. Our current assets, our long-term assets, our total, our current liabilities, long-term liabilities. Notice that the long-term debt, some of it has been moved to current portion because we know that 1,500 or 1.5 billion is due within 12 months. That's the definition of a current liability. So the terminology that companies use is called current portion of long-term debt. That's the idea that we have a long-term loan, but we pay so much each year, just like your car loan. And the part that you're going to pay for the next year is current portion. The rest of it is long-term. I made it as an adjusting entry. Many companies don't bother. They just move it around on the balance sheet itself without an actual journal entry. We got our balance sheet balance as it should, and we think that looks really good and are satisfied that we are able to put together all the pieces to go from a trial balance through the adjusting entries, through a correcting entry, using discontinued operations, create an income statement with earnings per share calculations, the comprehensive income, statement of changes in stockholders' equity, and a balance sheet. Whew. So we're feeling pretty good about all of that, and that we could do that one step at a time in a way that makes sense, and we have our new financial statements ready to go. And of course, we could always take those and make them a little easier to read, and change some of the things around to make it easier to follow and emphasize certain matters with lines and bolding and all that kind of stuff. But we got the idea, we made it balanced, and we're good to go. Thank you.